Good morning. Welcome to Trading Hour. I'm Sonia Shenoy. With me is Reema Tendulkar and Pavitra Parekh. And it's turning out to be a quiet day for the market. But there are plenty of global and local headlines that we're going to appraise you with over the next 1 hour. So stay tuned for that. The Nifty for now is holding up with a gain of about 30 odd points. The big global headline actually is that IMF has been warning of a tougher 2023. So there are still some headwinds upon us perhaps. IMF saying that United States, Europe, China, which are the main engines or which have been the main engines of global growth, are slowing down, and that perhaps could keep a lid on global markets. The US markets will be opening after a 3-day long weekend later today, so it will be interesting to see how that opens. But for our own markets, once again, there is resilience. The Nifty is up 400 points from the lows that we saw in the month of December of 17,800. And today I'm watching out for PSU Bank. So once again, the PSU Bank index is surging. We had, we have the likes of Canara Bank that are up at a fresh 52-week high. And in terms of business updates, the latest is Bank of Maharashtra, which has come out with an update a while back, while Federal Bank also reported a good, very strong growth and is at a fresh 52-week high. So a lot of banks in focus. Girls, good morning. A long hour ahead and long day ahead. But for now, things are looking a bit on the quieter side.
But not bad, right? Considering the SGX Nifty and the start was actually lower, the markets have managed to recover pretty well. But just to take that point about the recovery that we've seen over the last couple of days, the December low on the Nifty was hit on the 26th. The low was 17,774. So from that point, not 250 points, it's actually recovered 400 points from the December low, and that's a gain of 2.5%. So for a very long time, the markets were holding on to a trading range. Then in the month of December, with that fall that we saw, you got a sense that perhaps we're going to break down. But the markets very swiftly have recovered. So in the last 6 trading sessions, the Nifty has recovered 400 points. That's a gain of 2.5%. So once again, we are back in the trading range. One of the key levels to track will be 18,265, which was the high on the Nifty last week. Sectors doing well. Sonia spoke about PSU banks, but even IT, Nifty IT index has been steadily climbing up for the last couple of trading sessions. In fact, the Nifty IT, as we've been saying, underperformed the Nifty by 30% in 2022. The Nifty was up 5%, while the Nifty IT was down 25%. So the extent of underperformance was 30%. And, analysis shows that Nifty IT index has underperformed the Nifty for successive years only once in the last 15 years. So are we going to see an encore this time, or are we going to see a rebound? But at least the last couple of days have been pretty good for the IT season, and that's where all the news flow is going to come starting next week.
Oh, absolutely. So that space is going to be in focus for sure. And this recovery that you guys were talking about in the Indian markets, it's playing out across Asia, right? So when we did our first show in the morning, the Hang Seng markets were down almost 1.8%. From the lows, it's been an over 600-point recovery for the Hong Kong markets. All of Asia actually was down on the news that came out of China on their manufacturing, but they've all seen a sharp recovery. So that is something to track. It is a lot about the financials today on the back of their updates. A lot of the pharma names also doing well. So take a look at Apollo Hospitals, Cipla, Divi's. These are some which are, holding up in the green. On the downside, it is largely the metals, but of course, they had a solid 2.5% gain on the index yesterday. So, this is perhaps warranted. And then you also have Reliance, which is seeing some cuts today. So do keep your eye out on that. But let's talk about some individual stocks which are in focus today. While it does look quiet on the surface, there's a lot of action underneath. So let's start by focusing on the oil and gas space. Sonal is here with the latest news and updates. There's the windfall tax revision and also some updates coming through on ONGC, Sonal.
Good morning, Pavitra. Yes, let me start with that individual news on ONGC because it is a positive one, where the company is informed that one of their rigs, which is called Sagar Samrat, has started oil and gas production in the Arabian Sea. And this one has a capacity to handle up to 20,000 barrels per day of crude oil production and expected to contribute around 6,000 barrels per day of crude oil production in next few days as well. The maximum export capacity as far as gas is concerned for this rig is 2.36 million cubic meters per day. On the flip side, we have this news on windfall taxes being hiked coming in, and as expected, it has been hiked this time. So on crude oil production, it has been increased to 2,100 rupees per ton versus 1,700 rupees per ton earlier. So not such a big increase, but it's an increase nevertheless. Export duty on diesel has been increased to 6.5 rupees per litre from 5 rupees per litre. On ATF, it has been a bigger increase this time. So it has been increased to 4.5 rupees per litre versus 1.5 rupees per litre earlier. On petrol, it continues to remain nil. That is the export duty. So these are some updates coming in as far as the oil and gas space is concerned.
Okay, thank you very much for that. The other one that we're looking at is Emphasis. There's an interesting note that's come out of Ambit, and they advise using the near-term pain to accumulate the stock of Emphasis. So here's what Ambit has to say. Now, Emphasis gets more than 50% of its revenues from the financial space. Now, they cater to a lot of segments in the finance space, but one of the segments is the mortgage space, which basically means your home financing and refinancing. Now, what happens is that when the interest rates go up, mortgage refinancing, your home loan refinancing comes down. It typically goes up. You will refinance your home when the interest rates are going down, and therefore you will move to a competitive bank which will offer you a better interest rate. Now, as in the United States, as the interest rates started going up last year, mortgage business, the refinancing business, was hit quite a bit. And Emphasis has a play in the mortgage business. So according to Ambit, the company was hit over the last couple of quarters. And according to them, the revenue impact was nearly $45 million per quarter. And that is about 10% of their revenues. On the back of this hit, Emphasis stock underperformed the rest of the IT pack. So they're saying Emphasis stock underperformed 20% versus the rest of the IT pack over the last 1 year. But now they believe the mortgage business is close to a bottom, and that's what a lot of forecasts seem to be suggesting. And Emphasis exposure to the mortgage business has also been coming down. It's only at about 3 to 4%. So it's possible, Ambit says, that the Q3 earnings season is going to be weak on the back of this mortgage pain, on the back of higher furloughs. But their advice is that given the stock has underperformed the rest of the IT pack, its valuations are trading at a 22% discount to other peers like Coforge, LTI, Mindtree, and other combined entity. They would advise using any Q3 related pain or disappointment as an opportunity to acquire the stock or accumulate. So that's the view coming in from Ambit on Emphasis.
Okay, so that's on Emphasis, but LIC is buzzing in trade after brokerage initiates coverage. Nimesh is here to give us the fine print on that. Nimesh, over to you.
Hi, Sonia. So not only LIC, but the entire insurance space is buzzing in trade. Largely, I guess, on the back of the big, initiating coverage which has come from Kotak Institutional Equities. So they've initiated a buy on LIC with a target price of 1,000 rupees, a potential, 40% upside from current levels. Now, Kotak Note says that LIC's dominance is unparalleled with 37% APE market share in FY22. In fact, a company's high productivity versus the peers remains a bedrock for LIC's market dominance as well as cost leadership. In fact, Kotak believes that the gradual shift in product mix should boost the VNB growth despite moderate APE. In fact, the accounting bifurcation has led to a large increase in the embedded value and earnings, even as the return on embedded value was depressed. So, given the current valuations, it looks like the market is ignoring the strength of LIC, and hence Kotak believes it's a good buy. So they've initiated a coverage with a buy rating and a target price of 1,000 rupees.
All right, that is on LIC. Nimesh, thanks a lot for getting us all of the highlights of this report. One stock which is not doing well today is Zomato. This, as CTO and co-founder Gunjan Patidar resigns. Mangalam is here with all of the details on this one. Mangalam?
Well, it's the fourth big exit coming in from Zomato in the recent months, and this time around it is co-founder and chief technology officer Gunjan Patidar who's resigned. Remember, Patidar was one of the first few employees of Zomato, and he was instrumental in building the core tech systems for the company. Though the company says that he's left behind a strong plan for, leadership, etc., and the ones that will handle the business. But it does not bode well when you have the co-founder Mohit Gupta, new initiatives head Rahul Ganju, as well as Intercity Legends head Siddharth Jawar, all of them resigning in just the last few months itself. Now, it all boils down to the Zomato leadership, which is currently Dipinder Goyal, who's leading the food business, Albinder Dhinsa, who's heading the Blinkit business, and Hyperpure, which is headed by Rakesh Ranjan. So let's see where this goes from here in light of all the resignations that has happened. This is more strategic in nature than the others which were heading certain verticals, etc. So to that extent, it will be important to watch out for what happens from here. But 4 big resignations in just a few months does not bode well. Okay,
it doesn't, and that's the reason the stock is under pressure. Thanks a lot, Mangalam, for that. As we slip into a break, let's hear out some opinion coming through. We spoke to Sridhar Shivaram of Enam Holdings. Very interesting conversation over there. A couple of key sectors that he's looking out for. Listen in and we'll come back.
View for 22 was it's a tough year. I don't think it's changed much for 23. That macroeconomic, data still not looking very favorable for a global bull market. So this is going to be another challenging year. Like we saw in 22, we'll see a lot of ups and downs. at least for the first 6 months. That's our view, at least that's my view, that it's better to protect capital again in the first 6 months and take a call post that. Financials, our view remains that it's possibly on a sweet spot right now. Big bankers like Mr. Uday Kotak said it's a Cinderella moment, and I don't dispute that, because it's not just the loan growth. Actually, the bigger delta is the credit cost. When you speak to people in the banking sector, they tell you that it's not only the corporate sector which is not seeing the credit cost, even the retail, for whatever reason, strangely enough. In fact, our view is there's a K-shaped recovery. We should see retail NPAs coming through, because if the lower half is not participating in the growth, then there should be NPAs there. We think credit cost is going to be significantly lower. As a result, the earnings growth for banks will be significantly higher. As a result, we will see upgrades in financials. I think we're starting to engage with a lot of these companies because a lot of the froth is out. We think growth will come back maybe in the second half. So we need to be ready with our analysis on which are the good companies and what is the right price to enter some of them. What is the business model? Do they have a path to profitability? If a lot of this fits in, I'm not against any of the new age companies. Some of them are really good companies. Question is what.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. It is quite a quiet day, just around 35 points in the green, but from the lows, we have seen around a 90-point recovery. That's what's going on with the equity markets, but let's talk about commodities now. Manisha joins us, and today she's going to take us through what's going on with gold. Manisha.
Pavitra, thank you for that. Well, we are looking at very strong gains continuing in case of the gold prices. When you look at the last quarter of 2022, by the way, that was the best since June 2020. We are trading at a 6-month highs for the global gold prices. For the Indian gold prices, we're trading at a 30-month highs right now. The gains have been quite strong. We've closed the year quite positive in the dollar terms. For the Indian rupee, it was even better given the fact that Indian rupee depreciated by 10%. So for the Indian markets, the gold gains were at least about 12% there. Same is the case with silver as well. For the international markets, we're trading at a 5-month highs. For the Indian markets, we're trading at an 18-month highs for silver. Coming back to gold, and we are just 500 rupees per 10 grams away now from an all-time high that we saw in gold in 2020 there. The gold prices in the previous year also had gained up by nearly 18%. So we have seen those gains continue into this time as well. Markets are now looking at a slower increase in interest rates. There almost is a 90% probability or a chance being traded of 25 basis point rate hike by the Fed in the month of February there. The weak US dollar has been supportive. The higher bond yields is something that seems to be capping gains right now, but at $1840 per ounce, the gold is looking quite smart on the charts therein. That is a chart that tells you on what we have done in sense of prices in 2022. So as I said, in dollar terms, we've seen gold gain up by 1%, silver gained up by 4%. Outperformance came in from platinum, where we are looking at demand from the industrial sector now coming back as well. What the street will now watch out for is the US Fed, the December meeting minutes that are going to be released tomorrow. Further direction on what has been said about interest rates will clearly drive the markets from here.
Okay, thanks a lot, Manisha, for that. Well, moving on, the big theme really is the reopening of China and the impact that it could have on most emerging markets, on emerging market flows. The latest in terms of data is that China's factory activity has shrunk for the third straight month in December and shrunk at the sharpest pace in 3 years as COVID infections continue to rise in the country despite the government easing its zero COVID policy. Let's listen in to what Iswar Prasad of Cornell University had to say on the services sector outlook.
Certainly in the short run, there is going to be a little more destruction in terms of the services sector in particular, but more broadly in terms of industrial activity, in terms of consumption, and most major indicators of economic activity. It's going to take a little while for China, much like the rest of the world, to learn to live with COVID. And I think the answer to how significant this disruption is going to be in the short run largely depends on how effective the government is in terms of ramping up the vaccination policy and in terms of getting people vaccinated so that the negative effects of this sort of dislocation can be minimized. But certainly in the short run, by which I mean the first quarter of 2023, I think it's going to be rough riding. But I think beyond that, things are going to stabilize. The real challenge for the Chinese government is trying to revive both consumer and business confidence, because unless consumers feel comfortable spending again, even when the restrictions are reduced, and unless the private sector, businesses in the private sector feel comfortable about investing again, it's going to be very difficult for China to get the sort of employment growth and productivity growth, it needs to sustain higher growth.
Welcome back. A whole host of banking stocks are buzzing on the back of their Q3 updates. Abhishek is here with the details. Abhishek?
Well, Rima, to begin with, Federal Bank, there is strong deposit momentum that's seen over there. Deposit growth YOY is perhaps the best in last 10 quarters. Sequentially, that is quarter on quarter, it's the best in 7 quarters. So YOY, the deposit growth is at 14.8%, while on a sequential basis, it's at 6.5%. They have lost out on CASA ratio, which is now down to 34.25% when compared to about, 36.4% in the previous quarter. Loan growth momentum remains healthy at 19.1% YOY and about 4.3% sequentially. Remember that in the previous quarter, they had a loan growth of about 5 to 6% quarter on quarter. So on the back of strong base, this is a strong momentum. CD ratio, that's declined sharply to about 84.9% versus 86.7% in the previous quarter. CSB Bank, they are taking the sheen away from gold financiers, especially given the fact that their loan growth in the gold, momentum has been pretty strong. So deposit growth is at 18.9% YOY and about 8% sequentially. CASA ratio has decreased sharply to about 31.4% versus 34.3% in the previous quarter. Loan growth momentum was healthy, up about 25.7% YOY and 5.6% sequentially. In that, the gold loan portfolio has grown robustly, almost by 51% YOY and about 9.3% sequentially. So you are seeing an uptick in the gold loan share in the overall loan mix, now at about 47% versus 45.5% in the previous quarter. So X of gold loans, the loan growth is at 9.5% on a YOY basis and about 2.5% sequentially. Talking about South Indian Bank, the deposit growth is weak. However, the improvement in CD ratio augurs well that net interest margin in a rising interest rate scenario may improve sequentially. So deposits are at 2.7% YOY growth versus and 2.5% sequential growth. CASA ratio has declined slightly to about 33.8% when compared to 34.5% in the previous quarter. The CD ratio has improved to 77.4% when compared to 76.8% in the previous quarter. The loan growth pretty robust on a YOY basis, up about 18.5% YOY and more than 3% on a sequential basis. Back to you.
All right, Abhishek, thanks a lot for getting us that complete roundup of the business updates that we have from all of the financials so far. But let's also take a look at the market, which is not doing much at all. We have a technical check lined up for you. Mitesh Thakkar joins us now. Mitesh, we have seen a significant recovery from the lows, but it is still, very quiet on the index level. It is a lot about the financials, though, today. What looks interesting to you here?
I think the Nifty, still has been range bound. So we have not got a directional breakout or breakdown. It's kind of opened down and then come up, and I'm still waiting for it to get past 18,250, 275 zones. Having said that, the financial and the IT names look better. I think a lot of intraday patterns over there look very encouraging. And in fact, I have 2 IT names on my buy list. Emphasis BFL is something which is breaking out nicely. That's a buy with a stop below levels of 1970 for targets of 2065, and TCS as well is on the verge of giving a breakout. The 200 average is at about 3304, and the stock is trading about 10 odd points below that. So buy about 3305, keep a stop at 3280, and look for targets of 3360, 65 on the upside.
Okay, that's interesting. So you have a buy on TCS. Actually, a slew of these IT numbers are coming out next week, Mitesh, starting with TCS on Monday. Anything else that you'd buy ahead of numbers? Infosys, HCL Tech also come out next week?
That apart, I had a buy on Infosys, but HCL Tech is making what I would call is a good contracting triangle pattern. The breakout for the stock will happen once it starts trading past 1,050, 455 levels. So I think we're just about trading at that level. If the stock price manages to get past that, then I think a trading rally would happen to about levels of 1,090 or about 1,100 on the upside.
HCL Tech can head to levels of 1,090, 1,100. Thank you very much, Mitesh, for that. Let's move on and talk about Granules. That's in focus after the company entered into a strategic partnership with Greenco Zero C. Ekta is here joining in with the details. Ekta.
Well, yes, in what is a first of its kind collaboration, the news is that Granules has entered into a strategic partnership with the company Greenco Zero C. This is basically to collaborate for green molecule solutions. There is a wider application in pharmaceuticals according to the company. The first collaboration will be in Kakinada, Andhra Pradesh. Now, the company will be building a greenfield facility which is based on sustainability principles for large-scale manufacturing of key starting materials, APIs, as well as intermediates. The facility is expected to be spread across 100 acres. It will be commissioned in a phase-wise manner, and the company has said that the estimated project cost is around 2,000 odd crores over the next 5 years. What the company envisages to do and why this might be one of the first initiatives within this space is to utilize carbon-free energy as well as green hydrogen derivatives to produce value-added products such as PAP, paracetamol, metformin, APIs, as well as intermediates. So yes, it's definitely a step in the right direction when it comes to sustainability, but one will have to see what the execution of this particular collaboration would be.
All right, Ekta, stay on. Piramal Pharma is also higher in trade. Jefferies has initiated a coverage on the stock. Tell us a little more about that.
Well, yes, Piramal Pharma continues to be in focus. Jefferies has written on the stock. They have initiated with a buy and a target price of 150 rupees. According to them, the CDMO, which is basically the contract drug manufacturing segment, is on the cusp of a turnaround. However, headwinds which have been faced by the company in the past 12 to 18 months are getting resolved as per Jefferies. They estimate a 12% revenue and 21% EBITDA CAGR over FY22 to 24 based on factors such as the CDMO turnaround, steady growth for the complex hospital generic business, scale up of the consumer health business, and according to them, it also trades at attractive valuations of around 13.3 times FY24 and 10.6 times FY25 EV to EBITDA.
Thank you very much for that. Get into a break. As we do that, hear out some important market opinion coming in from Ramdev Agarwal, Chairman and Co-founder of Motilal Oswal Financial Services.
There's no excitement of grossly undervalued market, so you're going to rocket or something like that. So, and then global uncertainties are too many. So right now it's a kind of a subdued thing, but GST collections are very well held up. That's one data that gives you confidence that things are all right. So I think things are all right till November, December. So I think I would believe that 23 will be, we're starting in a very strong note of economic activity, heading into a lot of elections and things like that. And worst of global uncertainties, still the Ukraine war is on. Still inflation war is not over. What I hear, Andheri, Juhu and all, they're more closer to 75-80,000 rupees square foot for a worthwhile ready stock. So that seems to tell me that there is a very good market. Now the issue is how do you execute? We will be practicing consistency because that's what the wealth creation study we did. Okay, and they are not particularly consistent performers, And so, yes, of course, we'll look at it, some of the bigger ones who are stable, large, and they have they have the potential to be consistent. But they don't, the way they have played in last 10, 15 years, that has not been very consistent. These two are like literally 25% each, or actually bank is bigger if you combine private and public. So financials, lenders are like more like 30%, 32%. Banks are, IT is about 23, 24% of the total corporate profits. Now, I don't think both can do well together. The way index is constructed, I don't think both can be at a high. Anything can happen in the market, but I'll be very surprised that banks and IT both will be at a high. If a bank is at high, can you believe that people are selling, IT is down by 25, 30% and PSU banks are up by 70%. So that's the contrast you're seeing, So I think markets are rotating. Start studying them because they will change the track. Last year they said growth at a loss. So they were not ashamed of incurring losses. They were very proud of incurring a lot of losses. Now they're saying we have to get into profit. Like Baiju said, we want to be in the profit this year itself. So that kind of change. But saying is one thing, doing is yet another. And actually making profit to the extent of the market cap.
Okay, let us shift focus back to the broader markets now. Invite Jigar Mistry, co-founder of Buoyant Capital, to discuss the market fundamentals and the road ahead. Jigar, good morning and thanks for joining in. The big debate really now is whether the PSU bank rally that we've seen is something that can extend itself. Which side of the camp do you belong to?
Good morning, Sonia. I think that's a big debate raging on. it's if you put some context to it, it becomes a very interesting story. So, what used to happen is that private sort of banks used to run first, then PSEs used to rally, but by the time interest rate cycles would catch up, and therefore you will start seeing the NPAs cycle pick up as well, and then, it all used to come down a big train. The story this time around could be a little bit different because, see, prior to 2015 and post 2015, I think we are in two different banking sector worlds. Prior to 2015, if a corporate, received a large banking loan, it was somehow the bank's problem. And bank, if they didn't pay up, then banks used several evergreening mechanisms. I've lost count on the number of acronyms that were coined up at that time. And banks used to sort of keep evergreening that loan so that, they could not show it as an NPA. Post 2015, with Raghuram Rajan, doing the AQR, after that, basically, the IBC code was also launched after a few years. And then, the whole pile-up of debt that happened, that essentially has subsided over the past 3 or 4 years. And, banking balance sheets are the cleanest that at least I have seen in the past 2 decades. KV Kamath says the best in 5 decades, so we can take his word for it. But what this also means is that with the credit growth rising, you are actually not really looking at the NPA cycle follow. And if that were to happen, because last 2 or 3 years, the incremental lending has either been to governments or to the retail, and both of them are unlikely to blow up at the same time. In that scenario, people used to buy ICICI and HDFCs of the world to start with, and then SBI at a certain point in time was available at 0.3 times book. So, that got re-rated to 1 time. And with SBI's success, we are likely to see a lot of these PSU banks carry in its footsteps. One point of demarcation I would, however, make here is that with SBI, even when the corporate balance sheets were growing up, if you looked at the retail delinquencies of SBI for the past 10 years, right, they were actually better than HDFC Bank and ICICI Bank also. Now, if your base case was at that point in time that, look, the corporate loans are, NPA is not going to happen, then, it did make sense to re-rate SBI and, ride through that stock. But when we are talking of a PSU bank rally now, the look through into their books of accounts is very, very difficult. And it makes increasingly difficult for one to take a call on the credit cycle of those individual banks. So we were sort of owners of Canara Bank when it was in the 100 handle, 108 or something. But at 300 something, at close to 1 time book, ROE is not reaching 12-13%, ROE is not reaching 1% plus. It's a little difficult to make a case of a serious re-rating from here on. So we are not saying that, it will be a rough ride again, because, nothing sort of takes the wind out of a rally, like a NPA cycle brewing up. So that in absence of that happening, you might see the sort of share price performance mimic the earnings growth that you have seen. But my view is that a large part of the re-rating has broadly been done.
Okay, large part of the PSU banking re-rating is done. What could be the extent of the credit growth slowdown? Because you made that point that the deposit growth has not kept pace. If the banks continue to get lesser deposits, they will have less amount to lend, right? How does this typically play out? Will they? Do you think they expect? Yeah, hi. Do you think they will have to tap the markets? Is that what we should expect as the course goes on?
Yeah, good morning, Rima. So no, tapping the market won't be an option because you need to maintain a CD ratio, and therefore deposit growth needs to come through. Now, in absence, just to put the statistic, the deposit growth is at, the deposit growth minus the credit growth is at minus 8.8%, which is the lowest we have seen over the past 2 decades. Now, you need the deposits in order to fund the credit growth. And in absence of that happening, a large part of banks who are sitting on excess SLR, statutory liquidity ratio, might have to sort of, wind those down in order to fund the credit growth. But imagine the consequence of that happening. If, you go and sell your GSEC paper in the market at the time when there's a record government borrowing program going up, the RBI will have to come and sterilize the liquidity in the system by doing OMOs. Otherwise, the yield will just shoot through the roof, and that will have another unintended consequences. So I think for the larger banks, this is one number that at least we are closely watching out for. The deposit growth needs to keep pace with the credit growth. You know, a lot of banks have been reporting numbers. For the smaller banks, it is in upwards of 20% handle. For the smaller banks, it is still a good double-digit healthy growth. So my sense is that, you know, one part of the re-rating, you know, 2022, if I break down the year, 50% of incremental Nifty profits was driven by banking profits. Right, 2021, if you remember, the same thing happened with commodity companies. So with banking sector profits coming through, the re-rating largely happening, we are at almost all-time highs on the bank index, the Nifty bank index, and the re-rating through. I think this is an incremental number we would want to watch out for before, you know, we continue our bullish stance on these names.
Okay, got that. Jigar, good morning. The next big cue for our markets is the earnings season, which starts in around a week from now. We'll have all of the IT names go first. What is the kind of growth that you're penciling in for this quarter? And also for the full year, what is the kind of EPS growth that you're looking at?
Yes, good morning, Pavitra. Yes, so if you look at 2022, India was one of those shining places where the earnings cuts were moderate. Earlier, analysts were looking at 20% growth. That's now moderated to 12. But look at what Hong Kong was down 25%, China was down 30%. So it was, this shining bright spot where everybody could, keep their sort of places intact. Going forward, I think the financials earning in absence of NPA cycle brewing up will continue to be resilient, right? You won't see a lot of loan loss provisions, which were exceedingly high in the year 2020, and those sort of coming back, but you will continue to see a reasonable clip in terms of earnings growth. And that drove maybe 50% of earnings last year. This year, it could be slightly lesser, but, growth nonetheless. If I look at analyst estimates, they're looking at, I think, 12% including financials, 5-6% excluding financials, 20% in 2024. So the next year. So earnings growth, continues to remain reasonably okay, compared especially to where the rest of the world is. IT still remains to be seen. See, this quarter, our sense is that because of the cross-currency wins, you will likely see margins continuing to be maintained. Demand outlook is not, typically great, but the margin guidance that most of these companies have given will be met largely because of the cross-currency headwinds, I think. So in terms of reported earnings per se, I don't think there is a big disappointment in store.
Okay, no big disappointment. And you're saying the large cap IT names, right?
Yes.
Okay, got that. Since we're talking digital disruption, let's talk also about the new age tech companies. We've had a slew of exits, from a lot of these prominent names like Zomato. But profitability is picking up for many of these names, whether it's Nykaa, Zomato, even, PB Fintech. What do you do here? Do you sort of take the plunge and buy into these names, or do you keep away entirely?
So we have not sort of bought into a lot of these names since August 2020. So since their listing, I think one of the predominant views that we have held is that these are not really a play as much on Indian consumerism as much as they are a play on the US 10-year treasury rate, right? Because when you take a longer dated, cash flow stream of a business, let's say, which is a loss-making company, say Netflix, for example, and that's making losses for the first 15 years, and then it starts making profit. Now, when you discount a cash flow stream like this at a quarter percentage of US free cash flow, a US risk-free rate, then the number that you get is dramatically different from when you start discounting at 3 or 4%. So the time to buy a lot of these businesses is when you think the sort of rate cycle is done with. Valuations you can't really comprehend in absence of any profitability, and you can concoct, price to sales or price to footfalls, those sort of valuation multiples. But unless the cycle appears to have been peaked, there's little sort of point in buying a lot of this loss-making ultra-high duration assets, which how we call it. The right to win, I think, within the names that you mentioned, PB FinTech is one such business which we have traditionally been interested in. But there again, the online portal that the government and IRDA is planning to launch, we don't really know the impact that has on PB FinTech's model. So the only thing we are watching now is let's say the Bloomberg dot plot versus what the Fed dot plot is in terms of earnings rate peak. Everybody agrees that the next couple of meets, earnings rates should rise, and then it should, be stable around that. But what the Bloomberg estimate seems to suggest that there is an immediate taper, whereas what the Fed seems to suggest that there is a prolonged period of flatness before the rate starts falling again.
That point is taken, the dissonance between what the Fed has to say and what the bond markets are interpreting, and something has got to give. But we're out of time right now. Thank you very much for joining in. We need to cut across to the Microsoft CEO, Satya Nadella, who is speaking at the Microsoft Future Ready Leadership Summit right here in Mumbai.
At least in my professional career of the 30 years. And cloud still, you would say, is in the early to intermediate innings, because the first thing, the data point which is still stunning to me is how much more efficient the cloud is, right? The cloud native applications have really not yet begun. The fundamental point is that by 2025, you're going to have most of the applications anybody builds really at that efficient frontier of cloud native, right? It's 10x, 100x better even in some cases. But it's not just that. When you move to the cloud, for example, it's 70 to 80% more energy efficient. So if you want to sort of be more energy efficient on any workload, the first thing to do is to move to the cloud. And you also hedge against demand cycles, right? So by moving to the cloud, you're consuming only when you need it. So whether it's a hedge against energy, a hedge against demand, and get more efficient with cloud native development. And so to me, that trifecta is pretty compelling. And so we are investing a ton. We have 60 plus regions, 200 plus data centers worldwide. In India itself, we have regions everywhere. We're expanding the regions. But we're adding a fourth region in Hyderabad as well. So we are very, very committed to making, I'll call it, the cloud infrastructure available everywhere. But it's just not in the cloud, because every factory, every warehouse, every hospital is going to also have, or every retail facility is going to need compute where data is getting generated. So distributed computing will remain distributed. And so with Azure Arc, we're even making sure that the cloud infrastructure gets truly embedded in the physical infrastructure. That's sort of the future of the cloud. The cloud's not just in our data centers, but it comes to every place where you need compute to be. And we see tremendous momentum today when it comes to cloud adoption. In fact, when I think about Microsoft, that's been the big, when in the client server era, we sold a few servers in India. But in the cloud era, it's a completely different ballgame, right? When I look at every business and the cloud consumption, it's tremendous to see. We see Adani choosing Azure for its expansion, HFDC, using it, in fact, to consolidate all of the data platforms. And Yes Bank built their super app. So tremendous adoption of cloud. And in fact, the more and more I talk to my partners and customers here, I get excited about sort of even the unique things that are happening in India using the cloud. And that's really definitely a real departure from the previous era. The next imperative, it's all in the news, everybody's talking about it, is AI. And there's no question that when we look back 5 years, 10 years from now, we will talk about this transition. The good news for us at least, is that this transition from client server to cloud was interesting. It was sort of harsh in some cases, but we made it. Whereas in this AI transition, this builds on the cloud transition. It's very hard because the large models that are creating this transition are all mostly possible, quite frankly, because of that cloud native ability that the cloud provides to be able to train these large models. And in fact, one of the things that is sort of stunning is, we talk a lot about data and the amount of data that's going to be generated, but the point is these generative models are going to generate most of the data, right? And that is just starting. So we said, let's have some fun. So let's say we go to Dolly and ask it to generate some images. On Mumbai, it sort of creates beautiful art. This is going to be the future that you're going to all live in. So it's pretty, some of them are at least very interesting. Then we said, okay, that's cool. Let's ask ChatGPT, what does it think about the future of Mumbai? And it sort of came up with some pretty compelling narrative, right? I mean, it sort of has real optimism that I talked about. You know, it also shares. It talks about both, whether it's infrastructure, the tech involved, the culture. So pretty cool. So then I said, okay, let's get to the real meat of it. Let's ask it to rank order the street food of Mumbai. And it has an opinion, so it did come back, and Vada Pav wins. And then I asked it, like, where can I find the best Vada Pav? Not that I want to create some kind of a challenge for anybody here, but it sort of came back with places, whether, I don't know whether Bandra wants to argue its case, but it's here. And here's the thing. I then went on to say, okay, write a play where Vada Pav argues its greatness. And it did it. And so you should say, oh, okay, this is all fun. Let's actually see it. Like, it'll prompt it, and a little bit of prompt engineering, and it came back. Even Shakespeare would be proud of that. The thing is, this is all fun and games, right? But think about what you just are seeing. You're seeing the emergence of a new reasoning engine. This reasoning engine, clearly we will have to talk about it. What's the responsible use of it? What is the displacement it may cause? Those are all real important considerations. But the other side of it is, let's think about how it can augment every one of us in whatever it is that we're doing. Every knowledge worker is going to be more creative, more expressive, more productive. Every frontline worker will be able to do more knowledge work than they ever were able to do because of this co-pilot being there for them. Every design task, whether it's software engineering, mechanical design, architecture, pick your design task, is going to be that much more productive going forward. So it's ultimately, in my opinion, going to accelerate human creativity, human ingenuity, and human productivity across a range of tasks. It's going to be probably a golden age of what was predominantly, if you think about the computer revolution, it created mass consumer behavior change and productivity for knowledge workers. But what if we could spread that productivity across the board much more evenly? To me, that I think is probably one of the biggest things that we can look forward to. So the first thing, though, you have to do is really build a very robust data infrastructure, because there's no way you can benefit from a lot of the AI if you don't have robust data infrastructure. And that's where we are investing a ton. When we think about the data infrastructure, you've got to have the best-in-class operational data stores for SQL and NoSQL. And that's where we've really, with whether it's Cosmos and SQL, we've done some fantastic work. And in real time, by the way, in real time, you want to be able to take that data from your operational stores and feed it into your analytics stores. And from the analytics stores to governance, because one of the biggest things is provenance of data is going to be one of the biggest things we're going to be talking about. Where did the data come from? Where did the AI model get trained? Can I actually audit that training on top of that data? All of that, you need one integrated data framework. And so we're really making sure we build a fantastic piece of infrastructure so that it's available to every business.
Into trading hour, and there was news just flashing at the bottom of your screen that on the NDTV open offer, Adani will now be paying around 48 rupees extra per share for that for the NDTV shares. So Mangalam is here to fill us in with the details. Mangalam.
Well, it's a development in the Adani NDTV case where the Adani Group will now pay an additional 49 rupees per share, 48.65 to be precise, to those who tendered the shares, NDTV shares to Adani under the open offer. Why is that? Well, because on the 30th itself, the Adani Group's arm went ahead and bought shares from Radhika and Pranoy Roy, RRPR, for about 343 odd rupees, which is about 48.65 rupees higher than the earlier open offer price of 294 odd rupees. And in a requirement with SEBI regulations, which says that if persons acting in concert or acquirers buy stake from the other promoters, etc., at a price higher than the price of an open offer within 26 weeks of the open offer deal itself, they are required to pay the difference, and that's exactly what is being announced right now. So it is a development in the case wherein all those who tendered the shares at 294 rupees per share, the NDTV shareholders will now be given additional 49 rupees, primarily to match the price at which the Adani arm went ahead and bought shares from RRPR.
Okay, thanks a lot for that. That's on the NDTV open offer price that has been revised. Let's do one thing. Let's take a quick break. We'll come back and get you an update on the market. Very, very quiet day so far, but more on stock-specific action on the other side.
IT index has now moved to the high point of the day. It's up 0.7%, and it is the top sectoral gainers. It's pushed out Nifty Bank, which has seen a bit of a correction from the top. The Nifty PSU banking index was up nearly 1%, and now it's up only about 0.7%. So there has been a bit of a slip in the Nifty PSU banking index from the top. There you have it, and the IT index has moved to the top. Emphasis, a stock we were earlier highlighting, has now gained close to about 2%, as Ambit says they would use the near-term pain, the underperformance, to accumulate the stock. Emphasis has gained 2%, and TCS, one of the recommendations of Mitesh Thakkar, technically, that's also moved to the high point of the day. With that, we're out of time on Trading Hour. Thank you for watching. Stay tuned. Halftime Report is up next.